Hi, this is Brad Johnson, and welcome to this week's CIO Brief. I have with me our associate, Evergreen Capital's associate, Jesse Moncur. How you doing, Jesse?
Good today. Thanks for having me.
Yeah, you are an everyday presence of the company, so it's not like you had to fly in. So yeah, it wasn't too difficult, was it for you, Jesse?
It was pretty hard. It was pretty hard. Yeah. My wife wanted me home, but I'm here today.
Well, that's true. Working late on a Friday. I love it. All right. So today on tap, we are going to be talking about a few things. I like to start off these shows with a concept, an investing concept that I want to, eventually give on to my children and instill that lesson in them because I think investing lessons actually apply to a lot of great life lessons. And this one is specific to timing when it comes to investing. And I don't think there's ever an easy day to invest. The saying goes, the hardest day to invest is today. It always is like that. It's always today because, for example, the stock market right now, I feel like is a little overvalued. So it's hard to know, should we put more money into something that we know is trading at a high multiple, or when the stock market is extremely low, ironically, it's actually hard to invest at that time, like 2008, 2009, because you're like, well, is this going lower? Is the world falling apart? So the concept there is it's always hard. So we want to stay invested, just stay focused on the long term, keep plowing ahead. Any high level thoughts to that, Jesse, or am I rambling already?
No, you sound good. I think that's just the advice we need to hear today.
All right, well, let's put the agenda on the board. So, as we just talked about, valuations not exactly cheap. We have the JP Morgan Asset Management research today. That is actually published every month. I'm a big fan of their research. And what they do is they'll take a look at the stock market in terms of the PE ratio, the price to earnings multiple, relative to other points in time. And as you could see, it's not exactly cheap right now. We have a 22 multiple roughly as of this week. We've already had it updated. 22 multiple as of this week. Relative to history, that's fairly expensive. Historically, the PE ratio usually is in the teens, kind of mid teens. You can make the argument now that, well, we have better companies. We have software companies that are earning higher returns on equity. Facebook, Google, Nvidia, these are not the companies from 1950. This isn't GE, where you have a large amalgamation of companies that are in the manufacturing sector that actually don't generate as much cash, can't reinvest in the businesses, don't have extremely high profit margins. So it perhaps is not a fair comparison to treat today's multiple based on these companies versus historical, but it's going to be in the ballpark. We can't just have 30 PE multiples forever, right? And so 30 on today or trailing 12, like high 28, I think is the multiple, versus today on forward earnings is 22. So that's looking the next 12 months, which is what most people should look at the stock market. You want to buy things on the go forward basis, right? As opposed to backward looking, which is what most banks will do. And so that's why it's tough to get leverage on some assets when they're looking in the rear view, whereas you're looking forward. But anything out of that jump out at you, Jesse, that's not quite making any sense?
No, so far going great.
All right, good. Oh, the comparison here is not only the PE ratio, but also it's good to just do a check on the dividend yield of the stock market as compared to the 10-year treasury. So that's the 10-year bond. Yield that you're getting from dividends on the stock market is 1.5%. So not a lot of cash flows coming from these investments versus history, where it's closer to 2. And the 10-year bond, as you can see, has jumped up, obviously, this year relative to the last real decade where we had, almost zero interest rates, of course. And so that just gives you a comparison of what are my other options, right? The risk-free rate is that 10-year treasury. So we know we can go out and get at least some yield. And that helps to kind of give us a valuation on where the stock market is, a comparison, because we can see what relative cash flow options are out there. So long story short, the stock market, who knows what it's going to do? It's not going to tank tomorrow, most likely. It's unlikely to rip 20% for the next couple of years. Who knows? It could. You can't predict these things, which is why we're not saying, hey, the stock market is expensive, let's sell everything. What what we always recommend is you have a large percentage percentage of your portfolio allocated to the stock market. But what you want to do is light it up and down in terms of your total allocation. So if your steady state market's kind of a normal valuation, you don't think it's overvalued, you don't think it's undervalued, maybe you're at a 50% allocation, or some people like 80%, right? Depending on your exposure to things like private assets, venture capital, crypto. But if you do have a very diversified portfolio with all those assets, so maybe 50% is appropriate to you. And if you think the stock market's a little rich, like today, the valuations are high, you might want to scale that down to 40%. So take off 20% of your allocation to stocks. And now you can use that money to go buy maybe a real estate property or increase your allocation to private equity. Maybe you want to hold more cash. You're de-risking your exposure to equities. And then vice versa, if the stock market is cheap, if we have a situation like 2010, 2009, where after a crash, or even just a short couple months ago where we had a 20% really fast correction in the stock market in April, maybe you want to bump that allocation up to 60% when your normal allocation would be 50. So it's a spectrum, right? We want to flex it up and down. We're not saying any absolutes. We're not saying go fire sell all your assets because it's expensive. Nobody knows where the market's going. You can actually see bull runs go for extremely long period of time, which if you just look at the last couple of years, we've been on a ripper, right? And even if you look at the last 20 years, we've been on a very steep increase, which is fantastic. So there's no easy road to investing. And once again, today is always the hardest day to make new investments in the market because everybody has the same information. All the information is baked into the price. So all we can do is look for new opportunities and adjust our allocation and use portfolio management, right? Diversification to try to get the best returns by spreading out our risk over multiple asset classes and not just being 100% exposed to stocks. What is up next? So asset spotlight. Let's talk about GP stakes. GP stakes is one of our favorite investments. It is buying into the general partnership of private equity firms. And if you followed any of our research, if you followed any of our newsletters, you know that GP stakes is one of my favorite asset classes. I think private equity is probably the best business model ever created because you're getting to leverage other people, other investors' capital. You're going out and you're investing in companies at reasonable prices and then improving them and then selling them off generally in 3 to 5 years. And the history of private equity has generated tremendous returns. You not only get the benefit of those high returns now as a limited partner, but you also get the benefit of the general partner's economics. So that is the asset management fees. That is the 2 out of the 2 and 20 that you've probably heard of. And then you get to participate in the carry. That is the promote. That's the 20% of profits. So in other words, if the private equity firm was to double the value of an investment over 5 years, that's a 15 IRR. They would get to participate in 20% of those profits. They would make a nice chunk of change. And you, as the general partner GP stake investor, would also get your pro rata share, just like if you were a partner sitting at the table with them from that investment. So highlighting the performance, the 2025 performance today of GP stakes, it's had a great year, not a banner year. Some years it's been up well over 20%. This year, so far, it's trending towards that mid-teens total return. We'll see. We still got another quarter to go, but it's done quite well, especially relative to the stock market volatility that we saw in April. Right? We didn't see a 20% decline in GP stakes. It has steadily distributed a fair amount of cash flow to its investors. And it's done this in a difficult fundraising environment. It has not been easy for general partners, private equity firms, to go out and raise new capital because lately, the last couple of years, it's been difficult to sell assets and then return that money back to their limited partners, which enables them to go ahead and make new investments and new allocations into brand new private equity funds. So despite those headwinds, GP6 has performed really well. We're extremely happy with our investments in the space. And so this is just a really quick highlight on the sector. We'll do private asset and various asset spotlights each show just to give people an update on where a niche asset class other than just stock and bonds is as of this year. All right. So moving on to market manipulation and the Fed. This is a touchy topic. You might have seen the headlines with the president threatening to influence the Fed. If he had his way, he would get rid of Jerome Powell and put in a head of the Fed that would reduce interest rates. Now, I actually agree that interest rates are a little too high. I think that the Fed has kind of shown that they're lagging. They're a little bit late to the game. They were too late to cut interest rates during COVID after the stimulus. It was pretty clear that it was influencing pricing and we were having giant spikes in inflation. So they were a little too late, a fair amount late to correct that. And now I think they're probably late to actually start declining interest rates. And perhaps they were worried about the tariff impact to inflation. I think most practitioners, maybe not economists, but practitioners and looking at their businesses and just kind of getting a sense of where the economy is, I think most would agree that this is a pretty steep headwind. 5%, while not a high number on an absolute basis, looking at the entire history of interest rates, it is pretty difficult when you go from 0 to 5 so quickly and then to leave it at that rate for so long. So I would tend to agree, but that does not mean that we should be having an executive branch of the country influencing our financial markets to this degree. The Fed is supposed to be an independent party. I mean, frankly, I wish they just actually got rid of the Fed and pegged interest rates to the 2-year treasury. I think that would actually solve a lot of this problem, but that's just my soapbox platform idea that nobody seems to want to implement. So we'll move on. But I think the larger point here is that ideally we don't have one of our government branches influencing the Fed. I tend to think everything's going to be fine with this. We'll have a new Fed chair next year. The Fed has actually done a relatively good job of navigating a very difficult last 5 years with COVID, inflation, et cetera, even though they probably impacted a fair amount of it, but not an easy job. And so hopefully we can get to next year. We get a new Fed chair. Jerome Powell can take a great retirement, and we'll be on to a new Fed and executive branch relationship in 2026. All right, signal versus noise. Private assets approved for 401ks. This is fantastic news, actually. I think that most people are just in stock and bonds with their 401ks, and they have zero choice as to where their assets, their hard-earned money from their job, where those assets are being allocated. They don't get to influence the investment strategies. They just sign up for a 401k, which is a wonderful product. It gives the employer an opportunity to invest in their employees' future, right, post-retirement. So that is fantastic, but the hard part is that oftentimes you get a kind of like a limited set of options as an employer of what these investments can actually go into. And generally speaking, these are target date funds are the only options where it's like, okay, you start at 70-30, 70 stocks, 30 bonds. And then as you age, we start changing that ratio, making it more conservative because the theory goes as you get closer to retirement, you should want safer bonds and less exposure to equities. Now, I think that's a flawed concept given where we're at in the world. It might have worked 30 years ago, 20 years ago, when bonds were actually a safer investment. Now, they are extremely safe from a payment standpoint. The government's not going to default on bonds. However, what they are probably going to do, given the current state of our U.S. debt, is they're probably going to have a technical default. And that just means they are going to inflate away the debt. There's not a lot of courage in Washington for austerity measures. There's not a lot of politicians that want to go ahead and implement cuts to the economy, into our budget, where all of a sudden we are not printing money left and right. We are not coming up with gigantic government spending programs. So because they're not going to balance the budget, how else are we going to get rid of the trillions and trillions of dollars of debt and the large deficit that we have currently? Well, they're likely to just keep inflation running a little hot. They're going to keep the government spending high, which from a purchasing power standpoint will slowly continue to erode that debt in terms of the actual value of it. Sure, the number is going to stay the same, but if you have inflation, the actual value of that fixed amount of debt decreases in its actual impact by just inflating it away. So I think that's what's likely to happen. And that means that bonds are horrible investments when inflation is high. Because if you can imagine, you getting four and change, 4.2 something for a 10-year treasury. Well, what happens if inflation's 3-4%? Well, you're not getting any actual yield. So you couple that with the fact that people are living longer and are likely to live much longer, then you have a problem. If you're going to have a 30-year possible retirement, or even 40, right? Some people are going to live to 100 as the advances in medicine uh, come to bear here. You're going to need to access your portfolio in retirement for a longer period of time, which means you shouldn't be going fully to bonds by the time you're 60, 65, because you might be in retirement for 30 years. So we need investments and strategies to increase the total return profile of 401k portfolios, and arguably private assets, private equity, real estate have the opportunity to do that without dramatically tanking the volatility of somebody's 401k. You add a private asset, it actually reduces the volatility of somebody's portfolio. And the arguments against it is that all these things are illiquid, which yes, but it's a retirement portfolio. You're not going to need to touch that money for a very long time. Illiquidity is not that big of a deal. And they also argue that these things are too complicated for most investors, and that they won't understand them. I think that's just a wrong way to look at the world. I think we need to do a better job of educating people on the benefits of these asset classes. That's part of the reason why we do this show, is that we want to teach and educate people on the benefits of these assets, because we think it changes lives. It can change somebody's portfolio to get a higher return, which is they're not going to have to work as long. They can enjoy a better retirement. I think it's going to do a lot for the average retiree, provided we keep some sort of governors on what type of firms are allowed to get into this space. We can't have crazy, risky, never heard of firms fly by night without any oversight into all private 401k portfolios. There's got to be some sort of qualification, I think, in order to access this. And we also need to do this kind of slowly over time, because we're gonna skin our knee. We're gonna make some mistakes early. But as long as we do it in a measured way, I think this is a net positive for investors and retirees long term. All right. Well, we're wrapping up for today's show here. From the produced segment of the show. So now let's try to answer some questions that we have from our audience. And Jesse, if you have any questions too, by all means, jump in.
No, Brad, you did a good job. And for those listening, Brad received all of his media training from MIT, so he's on board with it. He's doing well. So I'll probably take us right to the top of this list, right where we started. Brad, in the last few months of 2025, what kind of opportunities should we as investors be keeping our eyes on? And what should we really be excited about in this last quarter?
Well, we named the firm Evergreen for a reason. So we try not to get too tactical about, okay, everybody go all in on crypto right now. So we try to just think about, okay, what is something that we want to own long term, 20, 30 years? And where we express our viewpoint about opportunities is by adjusting our exposure to it. Now, if you don't have exposure to GP stakes, okay, that makes sense. Maybe if you like that asset class, sure. I think now, and probably for the foreseeable future, GP stakes is going to be a good addition to people's portfolios. I am biased because we put a lot of our clients into it. Another asset class, maybe real estate debt, which I also believe in. To an extent, private credit looks pretty good too, which is lending money to businesses, right? And so debt looks pretty compelling across the board right now. And the nice thing is that I think you can keep that position on indefinitely. I think having some layer of debt in your portfolio where you are the lender. So instead of making an equity investment that can go to zero, when you make a debt investment, when you make a loan, especially a portfolio of loans, highly unlikely to go to zero. That is, in my view, a better allocation instead of bonds, right? If you just own a bunch of bonds, we've kind of talked about the problems there. But if you can be a lender to real estate and to companies at 10, 9, 11% interest rates with a historically very low default rate, I think that is extremely compelling right now versus equity that is extremely, high on the valuation spectrum. So unlikely to generate the same kind of returns that the stock market has generated the last, call it 13 years. It's been on a historic run. Once again, we still want to keep our exposure. We just might want to reduce it a little bit. And perhaps you add some debt if you don't already have it in your portfolio. And I think that's a way to increase the income that your portfolio gets uh, by either replacing those bonds that we talked about or replacing some of your stock exposure. And it also reduces the volatility of your portfolio. So if you have debt, the loan's value is not changing every day. The stock market obviously does this all the time. But when you add a little bit of debt, it reduces the volatility of your portfolio, which is actually a positive for most investors because it encourages good behavior, encourages them to not panic when we have in April when there is a 20% sell off, which this happens all the time. We have even years that turn out to be great. Like today's trending towards a pretty good year. I think, 11, 12% right now on the S&P. We had a 20% down month. So if you had panicked in April, you did not get to benefit from the spike back and you would be kicking yourself. And lowering the overall volatility of your portfolio actually then encourages you to just stay the course and not panic sell your stock. So that was a very long-winded answer to what looks interesting right now, but those are some ideas.
I think that's great. A couple things I wanted to key into. I'll touch on them one at a time. But first, you're talking about when the stock market's hot, when prices are high, you'd recommend selling off a smaller percentage of your assets there and investing them elsewhere, like in, did you say private debt?
Yeah, private debt is one of them that we're recommending to clients right now for sure.
So, is there such thing as doing this too frequently? And if so, how often is too frequent and how often is not frequent enough?
Yeah, I wish there was a engineering answer to that question. It's a very insightful question. It's pretty clear to know when it's too much. If you're looking at your portfolio every day and you're making tweaks and you're spending hours a day on your portfolio, unless you are a professional investor, this is a bad idea. You are wasting your time relative to what you could be doing. The vast majority, unless you're already kind of retired and you're already worth 10, 15, 20 million, whatever, the decisions that you're making are probably not going to be as impactful as your main career, especially like at your age. You could spend all day playing around with Robinhood, playing around with stock picks, and maybe earn a little bit of incremental return. But on a, on relatively speaking, over your entire career, on a small amount of money relative to when you're in your 30s, 40s, 50s, you're going to have a lot more money. Then it's going to matter more. So you want to learn and play around and cut your teeth when your wealth's not that high because you're really not taking major risks. It's when you are 65 and you quit your job and you have your millions of dollars and then you're playing around making crazy moves because you're not educated, you've never done it before. That's when you don't want to be experimenting, right? So to zoom out, you kind of want to do it tactically when things look maybe obvious, like okay, 2009, the pullback in April. Oh, wow, the stocks are on sale. Like, I think I should probably bump up my allocation a little bit. Some people just like to do it quarterly. Some people like to do it yearly. It helps if obviously you're working with a professional. They're going to help drive that that timeline for you. There's no right answer to it, but I think people know when they're doing it too much. And there's a ton of people that do it way too much. That would be better served if they were focusing on their main gig, driving the amount of money that they're making through just their specific industry or whatever they've chosen their career to be, and then figuring out investment kind of along the way.
Yeah, that was a great answer. Thank you so much. And especially for pointing some of that advice towards people my age at my point in my career. So I wanted to key into GP stakes. Now, when I met you and I started learning about GP stakes a little bit more, my initial thought was, now, why aren't more people flocking to GP stakes as quickly as I think they should? And yeah, I'd like to hear some of your insights there.
Yeah. It's really a function of just how new it is. It's not as well known. I mean, really, it's been around for maybe 8 years, less time in just the capacity of private equity and private credit and real estate. When it first started out, it was hedge funds. So people were investing in the general partnership of a hedge fund. And the problem with that is that hedge funds can blow up. And it's often one fund with one person that is the main decision maker. So it wasn't as good of a business model because you're investing in this hedge fund general partnership that every once in a while somebody wakes up on the wrong side of the bed, they get divorced and they just decide, hey, or I have a bad trading year or quarter or day even, and the whole firm goes away. So it wasn't as good of an investment. Like the principle, the theory was there, but it was being implemented in the wrong sector of general partnerships. Then when the firm started to look at, okay, private equity, private credit, real estate, venture capital, infrastructure, when they started looking at these private equity firms, they're like, oh, wait a minute, that's a much better business model. So, anyways, history of this asset class isn't long enough for that many people to be aware of it and to be pushing in with all their money to lower returns. So it's a little under the radar still. And then secondarily, the reason why these firms do it, the reason why they sell a stake in their firm is because they want to pursue new growth opportunities. Or maybe they have to make a giant 50, 100, $200 million investment into their newest fund. And they just had to do that a year, 2 years ago in a prior fund. So that's, I don't know about you, but it's hard to come up with $200 million, $100 million every year. And it's hard for even these captains of the industry. These are people that are all over the Forbes, 500 in terms of net worth, but even they have limits to their liquidity. So they're kind of a victim of their own success in that way, is that as the funds get larger and larger, which is, of course, as a GP stake investor, we want, because the larger funds, we get more asset management fees, which are contractual and come like clockwork. And then the profit's going to be higher on a larger fund. So we love that. And that's really the main metric for the industry. As long as assets under management continue to grow, we're going to do very, very well, which I think is a giant tailwind for the industry, as kind of proven by the fact that we now have the ability to do private markets and 401ks. The world is trending towards private assets, not just stocks and bonds. So anyways, those are two of the main reasons why it's been kind of under the radar and why, a private equity firm would sell a piece of the goose that laid the golden egg, so to speak.
Okay, thank you. GP stakes. I'm gonna keep giving you questions
We're
here because
hammering on GP stakes today. Well, so this is good, everybody. We're also using this as a way to teach Jesse to get him up to speed on some of our asset classes because, he is part of the company. He's got to know it just as well as I do at some point in his stay here at Evergreen Capital.
Yeah, and hopefully at some point I can be an investor here myself.
Well, there we go.
So how do payouts differentiate in GP stakes to other investment types?
I would put it's kind of like a combination between private credit and private equity. The private credit component is the asset management fees that are getting paid out. The private credit is done around 9% in total returns, and almost all of that is in current pay. That's in distributions that are paid monthly. So the private credit component of GP stakes is the asset management fees that are being distributed every month. And so that's similar. And then you have an equity component, which is the appreciation potential above that, which it tends to be the promote that we talked about. That's the 20% and the 2 and 20, the structure for most private equity firms. And so historically, it's gone up to 20%. There's been plenty of funds that have returned low 20s in their close-ended funds, right? So it's had a very strong track record, but we don't know what the future holds. I mean, eventually the word will get out eventually, right? That this is such a compelling asset class. So more money will come in. And as that happens, it's harder and harder to get those 20% returns. But because it's such a great business model, I'm a big believer in generating higher returns than the stock market, just because, once again, I think it's the best business model in the world for a long time to come. How long? I don't know. What do returns look like next year? Nobody can tell you. But what we try to do is just put our assets into strategies that we think have the potential to earn great returns relative to the risk. And I can't think of that many investments that have such a reduced downside when you are effectively investing in a giant portfolio of private equity firms that then are investing in a bunch of their own funds. So it's probably the most diversified way to invest in private equity. All right, well, that's enough for GP stakes today. I think we kind of went on a deep dive, which is great. Any other questions from the audience, or it's about time to wrap up? If not,
Yeah, everything's good over here. Thank
all
you.
right. Well, thanks for watching, everybody, today. We'll be back soon enough with our next show of the CIO Brief. All right, thank you. From Evergreen Capital, Brad Johnson. Take care.